Hi everyone, hope you're all doing well. Personally, I'm fine. Welcome to our fourth topic of financial accounting, that is financial accounts, final accounts, and end of year adjustments. We remember in our last lesson we covered the final accounts, that was the trading and the profit and loss account, and the balance sheet. But those were simple financial statements because they had no end of year adjustments. So during this lesson, we shall incorporate the adjustments at the end of year in preparing the final accounts. So you find okay, you find normally in an exam situation, you'll be given a trial balance and some other additional information below the trial balance, and then you are asked to prepare the final accounts. So in this session, we shall look at how to incorporate this additional information when preparing the final accounts. So the additional information that is usually shown after the trial balance, it relates to the following five items. So we have depreciation, we have the accruals, that is accrued expenses and the accrued incomes, and we have prepayments, and the prepayments we have prepaid expenses and incomes received in advance. And then we have bad debts, and we also have provision for bad and doubtful debts. So these five items are the most common items in the additional information provided to you together with a trial balance to do in order for you to be required to do to prepare the final accounts. That is the trading and the profit and loss account and the balance sheet. So this constitutes the adjustments that you have to make when preparing the final accounts. So we begin with the first additional information or the first adjustment, that is depreciation. So what is depreciation? So depreciation means the estimated loss in the money value of a fixed asset over time, owing to reasons such as wear and tear, owing to reasons such as obsolescence, yeah, with new technology, new models of machinery come in. So when as new models come in, the older versions will tend to decline in their value. Wear and tear, the constant use of the assets, yeah, will lead to the depreciation in value of that asset. Maybe other reasons such as accidents, the incidents of fire will lower the value of an asset. Yeah. So for instance, that chair that you're seated on there, yeah, I don't want to get to judge maybe how your house is like, but I believe that if it's not new, you cannot sell it at the price at which you acquired it at. Yeah. So you cannot sell it at the same price at which you bought it at when it was new. So the price of an asset, of a fixed asset, declines in value over time. So this will be referred to as depreciation. So depreciation is a common item that is given when preparing the final accounts. So we have various methods of calculating depreciation. We have the first one, the straight line method. The straight line method charges a constant amount of depreciation per year. The straight line charges a constant amount of depreciation per year. So if it is 1,000 shillings, it is 1,000 shillings for year two, for year three, for year four, until the end of that asset's life. Yeah. So and thus it's referred to as straight line because it's a straight amount of depreciation. Yeah. It's a constant amount of depreciation. So therefore, we can say that this method spreads depreciation evenly over the life of the asset. And the method of calculating depreciation, periodic depreciation, or the annual depreciation, is equal to the scrap value, sorry, the cost, that is the price at which that asset was acquired at, less the scrap value divided by the working life of the asset. So the working life of the asset is usually quoted in the number of years the life is expected to be held by the business. So with that, we will be able to get the constant amount of depreciation per year. That is a periodic depreciation. So where cost is the acquisition cost of the fixed asset, as I had said, and the scrap value is estimated life of the asset at the end of its working life. So at the end of its working life, tukimaliza kuitumia, what will be the value of that asset? So if its working life is 5 years and you are through that asset, at what price can you sell that asset at? Yeah, what is the scrap value? So yeah, so therefore the periodic depreciation or the annual depreciation shall be equal to the acquisition cost minus the scrap value at the end of its working life divided by the working life that is usually quoted in years. And we have an example here that a machine costing 10,000 shillings is purchased. Its expected working life is 10 years and the estimated scrap value is 1,000 shillings. So the annual depreciation as per the fixed straight line method is equal to the cost, that is 10,000 shillings, minus the scrap value as you've been given in the question, divided by the working life of the asset, which is 10 years, which gives us 900 shillings per year. So that is according to the straight line method of calculating depreciation. So if it's straight line, the depreciation is constant for every year. So in this case, for this asset, it's depreciation for each year over the entire 10 years working life is 900 shillings per year. So that will not change. And then you have another method of calculating depreciation is the reducing balance method. So unlike the straight line method that charges a constant amount, reducing balance method charges a reducing amount of depreciation. Yeah, so the amount of depreciation under the reducing balance keeps changing as the life of the asset progresses. Yeah, so and in our case, this is being a reducing balance method. It means that the amount of depreciation declines over time as the value of the asset is declining. Yeah, so the value of the asset is declining, and in effect it will also lead to the decline in the depreciation amount over time. So you find that the depreciation in year 1 is 10,000, in year 2 is 9,000, in year 3 is 8,000, in year 4 it's 7,000, in that order. So it changes, and in this case it changes by reducing. Yeah, so under reducing balance method, we charge a fixed percentage on the diminishing value of the asset. So when you charge a fixed percentage on the diminishing value of the fixed asset, you find that the amount of depreciation will decline over time. So for instance, we have a machine that is costing 10,000 shillings that is purchased. Its depreciation is provided at the rate of 20% per annum by reducing balance method. So we are told that the depreciation approach here is the reducing balance. So we are needed to show the depreciation per year for the asset. So you said that under this method, we charge a constant amount. And the constant amount is 20% per annum on the value of the asset. So our solution here to determine the depreciation for each year is we take 20% on the value of the asset for each year. So for instance, for year 1, as I have highlighted there, for year 1, the value of the asset is 10,000 shillings. Its depreciation is 20% on its value, that is 10,000 shillings in year 1. So 20% of 10,000 is 2,000 shillings. Yeah, it's 2,000 shillings. So moving forward to year 2, the value of the asset will have reduced from 10,000 minus 2 to 8,000. So as such, in year 2, the value of the asset at the beginning shall be 8,000 shillings. And its depreciation shall be 20% of the value at the beginning of year 2. That is 8,000 shillings, which gives us 1,600 shillings. So 1,600 shillings is a depreciation in year 2. So and then we move on forward to year 3, where the value of the asset will have declined from 8,000 to 64. That is 8,000 shillings minus 1,600 will be now the value of the fixed asset to take forward to year 3, which is 6,400 shillings. So 8,000 minus 16 will give us 64. So 64 is a value to take forward to the third year. So therefore, the depreciation during year 3 shall be equal to 20% of the value in year 3, that is 6,400, which will give us 1,280. So the 1,280 is a depreciation in year 3. So to move forward to the 4th year, the value of the asset will decline from 6400 to 5120. That is by deducting 1280 from 6400. So 6400 minus 1280 will give us 5120. So 5120 will therefore be the price, the value of the asset to carry down to the fourth year. And then the depreciation during the fourth year shall be equal to 20% of the value of the asset in the fourth year, which is, please use your calculator to determine that. And the process goes on and on and on and on that way. So you find that the amount of depreciation declines, yeah, from 2000 to 1600 to 1280 to something small there, as the life of the asset progresses until its working life is over. And you also notice that the book value also declines from 10,000 to 8,000 to 6,400 to 5,120. So and it goes on that way. So you can use maybe in your own free time, try and find out whether what I'm saying is true. So that is the reducing balance method. And then we have the sum of digits method, another approach of calculating depreciation. So the sum of digits takes the years as a bear with me. So the sum of digits method takes the years in the working life of the asset as digits and then sums them up. Takes the years, which in this case will be referred to as the working life of the asset, as digits and then sums them up. So like we have in our example here, a machine costing 10,000 shillings is purchased. Its working life is 4 years with an expected scrap value of 2,000 shillings at the end of the 4 years. Determine the depreciation for the 4 years using the sum of digits method. So you say that the sum of digits takes the years as digits and then sums them up. What has been done here? So the years, in this case, we have year 1, year 2, year 3, year 4. So digit 1, digit 2, digit 3, digit 4. So we add them. So the sum of digits therefore here shall be 1 plus 2 plus 3 plus 4, which gives us 10. So that is the sum of digits. And then after getting the sum of digits, to get the depreciation for every year, we take, we reverse, yeah? We reverse the number of years. So from the beginning to the end. So if the working life is 4 years, then we begin with 4, the year 2 will take 3, year 2 will take 2, and year 4 will take 1. Yeah. So as you've done here, so year 4 will take 4, year 1 will take 4, year 3 will take 3, year 2 will take 3, year 3 will take 2, and year 4 will take 1. And then we divide by the sum of digits that we have determined, yeah? In which case here it's 10. Yeah. So we divide the digits by the sum of digits for each year, and for the numerator in this case, we take the last year, and then we go declining downwards. Yeah. So for year 1 we take the 4th digit. For year 2 we take the 3rd digit. For year 3 we take the 2nd digit, and for year 4 you take the 3rd digit, and then we multiply by the cost price, the cost price of the asset minus the scrap value in brackets. So the cost price in our case is 10,000 shillings and the scrap is 2,000 shillings. So we multiply that, we get the depreciation for the year. I hope you get that. So for year 1, it's 4 divided by 10 multiplied by, in brackets, 10 minus 2. So which is 8,000 times 4 divided by 10 will give us 3,200. For year 2, it's 3 divided by 10 multiplied by 10,000 minus 8,000. That is the cost minus the scrap, which will give us 2,400. Year 3, we take 2 divided by 10 multiplied by 8,000 will give us 1,600. And finally, in year 4, we take 1 divided by 10 multiplied by 10 minus 2,000, which is 8,000, will give us 800 shillings. So being the depreciation on year 4. So you notice that this will be also like the reducing balance method, whereby the depreciation amount declines over time. So that is a sum of digits method. Now we've calculated depreciation. We've seen the three methods of calculating depreciation. But then now the question is, after determining the amount of depreciation, what next? Yeah, what next? So here we're supposed to adjust for this depreciation in the final accounts. Yeah. So how do we adjust for depreciation in the final accounts? So this is a question that we are to answer now. So therefore, treatment of depreciation. So for these adjustments, they have to be incorporated twice in the books of accounts, so that in the end we have our balance sheet balancing. So for each adjustment, it has to go twice in the books of accounts. So therefore, for depreciation, the two adjustments will, that first, it will be in the profit and loss account. So in the profit and loss account, depreciation will be shown as an expense. So where you have the other expenses, we need to have to see depreciation also listed there as an expense. So depreciation is an expense to the business. Yeah. So one thing you need to note is that depreciation is an expense to the business, and as such, depreciation should therefore be treated as an expense in the profit and loss account. So please note that depreciation is an expense, and therefore it should be treated as an expense in the profit and loss account. And then after the profit and loss account, we move to the balance sheet and show the depreciation as a deduction from the book value of the fixed asset. So the second adjustment that we need is that we go to the balance sheet and deduct the depreciation from the book value of the fixed asset. So we shall do an example to illustrate all that. So, but please note what I'm saying. So depreciation, one, in the profit and loss account, it should be shown as an expense, and then in the balance sheet, the depreciation should be deducted from the book value of the fixed asset. Then we move forward to our adjustments. Our second adjustment is accruals and prepayments. So under the accruals, we have the accrued expenses, and we have the accrued incomes. Under prepayments, we have prepaid expenses and incomes received in advance. So let's move on to the details of each. So we have accruals and prepayments. So financial statements are prepared on the basis of the accrual concept. So what does the accrual concept mean? Yeah, that is in the profit and loss account. So in the profit and loss account, we use the accrual concept of accounting. So under the accrual concept, you say that expenses will be recognized in the in the profit and loss account as and when they are incurred. Expenses will be recognized in the profit and loss account as and when they are incurred, regardless of whether cash has been paid or not. That is the accrual concept. Expenses will be recognized in the income statement or the profit and loss account as and when they are incurred, regardless of whether they are paid or not. For incomes, under the accrual concept, they be recognized in the profit and loss account as and when they are earned, regardless of whether cash has been received or not. Incomes in the profit and loss account will be recognized as and when they are earned, regardless of whether cash has been received or not for these incomes. So that is the accrual concept of accounting. So this is a concept that will follow when adjusting for accruals and prepayments in the income statement. So what are accrued expenses? So an accrued expense is an expense that has been incurred but has not yet been paid by the business. An accrued expense is an expense that has been incurred but has not been paid by the business. For instance, rent expense for the month of April, but not paid in April but in May, will be an accrued rent, as at the last day of April. Then we have prepaid expenses. These are expenses that have been paid but have not yet been incurred. Expenses that have been paid but have not yet been incurred. Yeah. So for instance, we may have prepaid rent. For instance, rent for we are currently in the month of June. Assuming you pay rent for the month of July and August in the month of June. So during the month of June, the rent that you have paid for the month of July and August will be prepaid rent. So rent that has been paid but not yet incurred. That will be a prepaid rent expense. Then we have accrued incomes. Accrued incomes are incomes that have been earned. Incomes that have been earned. E-A-R-N-E-D. Incomes that have been earned but not received. Yeah. Incomes that have been earned but no cash has been received in their respect. For instance, rent. Maybe we have some building somewhere you're not using. We've given it to some tenant of ours. This tenant has not paid us rent for the month of, say, June, the current month. So this is an accrued income that has been earned but has not yet been received from our tenants. And then we have incomes in advance. These are incomes that have been received but not yet earned. Yeah, we've already received cash on the in respect to this income, but we have not really earned this income. So, for instance, as a university, we've received rent from you, the student. So not rent, but school fees for the September-December semester. Yeah, yet hatujafika September-December. Now we register September-December. So that means that this fee to us as a university has been received in advance, but has not been earned because the student has not attended classes yet. We have not yet gotten to September and December. So this will be a school fee in advance. So we need to adjust for these 4 items. So how do we adjust these items in the balance in the financial statements? So accounting for accruals and prepayments. So we've said that we follow the accrual concept, whereby for expenses, we recognize them as when they are being incurred, not when cash is, not regardless of whether cash is going out or not. And for incomes, we recognize them when they are incurred, and incomes recognize them when they are earned, regardless of whether cash has been received or not. So that is the accrual concept. And then another thing that you need to follow here is a duality concept. Yeah, just like the concept of double entry, that any item in recording of transactions in the books shall have a dual effect in the books of accounts. So that in the end, we have a trial balance that is balancing and we have a balance sheet that is balancing. So in the end, we have to follow the duality concept of accounting. Yeah, the duality concept, just like the double entry concept of accounting, that each adjustment has to be made twice, so that in the end our trial balance will balance and also our balance sheet will balance. So the duality concept. So the same case will apply to these accruals and prepayments. They shall have to be adjusted for twice in the books of accounts, in the financial statements, in order for us to have a balancing balance sheet. So therefore now, how do you adjust for accrued expenses? So we have to follow the duality concept, the double adjustment. So for accrued expenses, in the income statement, we will recognize accrued expenses because this is an expense that has been incurred. It's only that we have not paid money for it. So you have to recognize it in the P&L account. So how do we recognize P&L, the accrued expenses in the profit and loss account? So the effect, what you need to note is that the effect of accrued expenses is that we have an understated expense account balance in the ledger. we have an understated expense account balance in the ledger. So how does this result? So it happens that maybe we normally record in the books of accounts when an activity has taken place, when you have paid. So for expenses, we only recognize, we enter in the books when we have paid for this expense. But then if it happens that you have not paid for this expense, which you are supposed to pay, it means that there is no entry in the ledger. So if there is no entry, then there is an understatement. So as such, the effect of this will be that this expense will be understated, owing to the fact that this expense has not been paid. Because we have not credited cash, we have not debited the expense. So the effect will be an understatement. So to correct for this, we add the accrued expense to the respective expense account. We add the accrued expense to the respective expense account. So we shall have an example to illustrate that. And then in the balance sheet, the accrued expense is regarded as a current liability. The accrued expense will be regarded as a current liability because this is an expense that we as a business have not paid, so we owe the provider of that expense. So if, for instance, it's rent for the month of June, we haven't paid, it means we owe the landlord that rent. So the landlord then becomes like a creditor to us. So the creditor is a current liability. So as such, an outstanding expense or an accrued expense will be treated as a current liability. Then we move on to the accrued incomes. These are incomes that have been earned but not yet paid. So the effect of accrued incomes is that we have an understated income account balance in the ledger. So how does this result? So just like with the accrued expenses, so for incomes, we normally record them in the books when we receive cash. Yeah. So let's say we receive cash on rent. So we therefore need to go to the cash book and debit the cash account and then credit the rent income account. But then if we have not received this income, we do not record it anywhere. So therefore, there will be an understatement in respect to the accrued income that has not been received. But this income has already been earned. It's only that we have not yet received the money on it. So as such, there will be an understatement in the affected income account. So to correct for this, we add the accrued income in the affected income account. Yeah. So if it is rent for the month of June, hatujaipokea, so we still have to recognize this rent, regardless of whether it has been received or not. So this rent has to be added to the respective income account. So as such, we add the accrued income to the respective expense figure in the profit and loss account. So P&L here means the profit and loss account. And then in the balance sheet, we regard the accrued income as a current asset. Yeah. So it's a rent maybe we're supposed to receive from our tenant. He has not paid us, so he owes us. So to us, the tenant is now like a debtor, and a debtor is an asset to the business, is a current asset to the business. So therefore, the accrued income should be shown in the balance sheet as a current asset. Then we move on forward to prepaid expenses. A prepaid expense is that which has been paid but not yet incurred. So we've paid rent for the month of July and August. So that rent has been prepaid. So the effect of prepaid expense is that we have an overstated, an overstated expense amount in the ledger. So this results this way. So we pay rent for the month of June and for July and August, yet we have not yet reached there. So this rent is prepaid. So what we do is that we debit the cash account with the rent. So assuming it's 2,000 per month, so we shall debit with 4,000. That is for the rent for July and August for 2 months, each month being 2,000. So in total, we debit 4,000, and then we credit rent expense, rent. Oh, yeah, in sorry, in expenses, yeah. Also, so when we are paying an expense, yeah, assuming we've paid rent for the month of July and August, say 2,000 each. So we shall open a cash account and credit our cash account with 4,000 shillings, and then debit the expense account with 4,000 shillings. So in effect, our expense account will be indicating that we paid rent during the month of 4,000 shillings, which in real sense doesn't belong to the current month, but for the subsequent months. So there will be an overstatement by 4 months. So this will be misleading if we take the expense amount, the rent expense amount as 4,000. Yeah. So as such, we need to deduct the overstatement. So as a result of the overstatement in the affected expense account, we need to deduct that overstatement in order to record and report the true expense figure in the profit and loss account. And then in the balance sheet, so we shall do an example to illustrate all this to make the understanding easier. So in the balance sheet, the prepaid expense is regarded as a current asset. Yeah. So you've paid rent for the month of July and August. We've not yet gotten there. So it means the landlord owes us the service of that rent. Or if he doesn't give us the service, he needs to refund us back our money. So it's like he owes us. So he's therefore like a debtor to us. As such, we treat the prepaid expense as a current asset. So it shall therefore be shown in the balance sheet as a current asset. Then incomes received in advance. This is an income that has been received but not yet earned. Yeah, an income that has been received but not yet earned. So the effect of incomes that have been received but not yet earned is that we have an overstatement in the affected income. Yeah, so the overstatement results from having received an extra amount. Yeah, so for instance, maybe our school fees at the East African University, we're receiving school fees from you, the student. We're receiving school fees from you, the student of say, yeah, the month we are in the month of June. So we've received your school fees for the month of September, for the semester September to December. Yet you've not gotten there. So this is an income that you have received in advance. Yet hatuja kushughulikia during the semester of September to December. So this means that this income is prepaid. So what we do as a university, we go to our cash book and debit our cash account and credit our school fees account. Yeah. So but our school fees as at the current semester of May to August will show an overstatement in respect to the school fees that you've paid us, because you've paid us an extra amount. So this will be misleading to us if we take the fees of September as a fee of of the current semester. I don't know whether you are getting me, but this will be misleading. It will be an overstatement. So to correct for this, yeah, we deduct the prepaid income or the income received in advance from the affected income account in order to report the true figure of income. So when you have an income in advance, we deduct from the affected income in order to record the true income figure. And then in the balance sheet, the prepaid expense, so the income received in advance. In the balance sheet, the income in advance is regarded as a current liability. In the balance sheet, the income in advance is regarded as a current liability because this is money that we've received from our customer for a service that we have not rendered. So we owe the customer that service, and if not, if we don't give him that service, we should refund him his money. Yeah. So therefore, we are like to us that the customer is like a creditor to us, and a creditor is a current liability. So as such, in the balance sheet, the prepaid income will be shown as a current liability. So we need to note that maybe for the accruals, that is the accrued expense and the accrued income, we add them. Yeah, we add them in the P&L account. Whereas for the prepayments or the ones in advance, we deduct them. So the accruals lead to an understatement, therefore we add. For the prepayments, they lead to an overstatement, therefore we deduct. So those are accruals and prepayments. Next, we move on to the other items, adjustments. That is the fourth one is bad debts, and the fifth one is provision for bad and doubtful debts. So we move on to their details. So bad debts. So what is a bad debt? So a bad debt is a debtor that has been declared irrecoverable. Yeah. So you have a debtor. It even happens in our personal relationships. So like if you lend someone some money of yours, and then later maybe something happens, maybe you become bitter enemies, amuongeleshani tena, so you don't expect this person to pay you back. So to do the most logical thing is to cancel that debt. Yeah, so you write it off as a bad debt. So a bad debt is a debt that has been declared irrecoverable, at that hii pesa yenyewe hii mtu atanilipa. Maybe it happens, maybe God forbid he's dead, or maybe he's gone to jail. You don't expect this person to pay you back, so you write this debtor off as a bad debt. Yeah, so a bad debt is a debtor that is been declared irrecoverable owing to some reason. So how do we treat bad debt? So bad debt is regarded as an expense to the business. So the duality concept still has to apply. So we have to adjust for bad debts twice. So one, we record the bad debt as an expense. So therefore, we go to the profit and loss account and show the bad debts as an expense. And then, secondly, we go to the balance sheet and deduct the bad debts from the debtors figure. So the bad debts will decrease the debtors in the balance sheet. The bad debts will decrease the debtors in the balance sheet. So for bad debts, we treat them as an expense in the profit and loss account, and then in the balance sheet, the bad debts will be reduced from the debtors in the balance sheet. And then next we have the provision for bad and doubtful debts. Okay, the provision for bad debts. Yeah. So before you write off a debt as a bad debt, normally you anticipate that this person may not pay you. Yeah. So during that period of anticipation, you write him off as a provision for bad debt. So you don't go just directly and write him off as a bad debt, but you first do a provision for bad and doubtful debts. So what is a provision for bad and doubtful debts? So um, so it's a matter of common experience that bad debts are anticipated out of existing debtors. So changes in provision for bad and doubtful debts are charged to the profit and loss account, and the entire provision for bad and doubtful debts is then shown as a reduction from the debtors figure in the balance sheet. So, okay, for instance, okay, let me give an example of when a bad debt arises. So a bad debt will arise, say for instance, you have a debtor, and this debtor, you've heard of some rumor that he's just been arrested because he's suspected of a very serious criminal offense. So he's in court, there are court proceedings. If he's found guilty, he's in jail for the entire of his life. And there's a 50% chance that he may be declared innocent and resumes his normal activities and pays you back. So there is that anticipation. That is that this debt of mine is in court. He may be in jail, he may get out. So there's that possibility that he may pay me or not. So that anticipation. So with that anticipation, you create a provision for bad and doubtful debt. So you don't write him off as a bad debt, but you write him off as a provision for bad and doubtful debt, because you're not sure. This person is in court. He could land in jail for a long time. He may not pay me back. He could be innocent. He could be released. He'll pay me back. So there's that anticipation. So for that anticipation, you create a provision for bad and doubtful debt. So how do we treat the provision for bad and doubtful debt? So the duality concept still applies. So in the profit and loss account, in the P and L account, the increase in provision for bad and doubtful debt is regarded as an expense or loss to the business. Yeah. So if the provision for bad and doubtful debt increases, we treat it as a loss to the business. So it should be shown on the under the expenses in the income statement or in the profit and loss account. And if there's a decrease in the provision for bad and doubtful debt, it should be shown as an income in the profit and loss account. So decrease in provision for bad and doubtful debt is shown as an income or gain in the profit and loss account. So where we have the other revenues in the profit and loss account, we should see the decrease in provision for bad and doubtful debts. And then in the balance sheet, the provision for bad and doubtful debts should be deducted from the debtors figure in the balance sheet. So that is it. Those are the common adjustments that we make in the financial statements when preparing the financial statements. They are usually given as additional information in the trial balance. So we have a format of the of the trading and profit and loss account. These are notes that I've shared with you, so you can refer to the notes. So that's a format of a trading and profit and loss account, which shows the sales, the cost of sales. Shows us the gross profit, shows us the other revenues, the other expenses, and the net profit. Then you have another example of a balance sheet, shows us the fixed assets, the current assets, the liabilities and capital. And then we have an example. So let's work on this example. Let's work on this example.